Hey there, happy Friday here from Dan, the CPA mortgage guy with Summit Home Loans. Here to talk to you about one of my favorite down payment sources, the 401k loan. And a lot of times people ask, well, why would I borrow from my retirement to purchase a home? Isn't that going to hurt my wealth? And the answer is, I think it would help your wealth far better than if you just left it in your 401k and chose not to buy a home. So, because it usually grows faster since you are able to leverage that growth. I'll talk about what that means here in a minute. So let's talk about an example there. Let's say your $500,000 home is appreciating at an average rate of 5%. That means you gain 5% of that wealth of $500,000 is $25,000. So you gain that in wealth that very first year, assuming appreciation rate of a conservative 5%. So if you borrow that from your 401k, let's say you borrow $25,000 from your 401k to make that down payment, and you end up paying 7% interest on that, which is, by the way, interest you pay to yourself. So you're actually not losing any wealth there. So that's $1,750 in that first year that you would owe on interest alone. So the wealth recoup that you get that from using your 401k to purchase a home, if that's the key that unlocks your ability to purchase a home, you will recoup almost all of that in your first year because you have that $25,000 gain in wealth, and you, again, quote, lose, and you're not really losing that $1,750 because you're paying it back to yourself, right? So you recoup almost all of that in wealth in your very first year. So what are some of the rules on using a down payment source, 401k as a down payment? Well, first, it has to be administered at your current workplace. So if you've changed jobs but haven't rolled your 401k into your new job yet, it has to be in there before you're able to use it. Okay, and it must allow personal loans. And most already do that, but you'll have to ask your HR, your 401k admin if they can get approved if it isn't for some reason. And you can pay it back over the life of the mortgage. It can take 30 years to do that. It doesn't have to be paid back in 5 years necessarily. Again, check your rules for your 401k administration, but usually they allow something like this. Okay, and it also, if you take out a loan against yourself, that doesn't hurt you on your debt to income ratio. If you don't know what that is, that's one of your qualifying factors in qualifying for a mortgage. So that's a pretty nice thing about 401k loans is to factor into your DTI. Okay, and missing payments doesn't affect your credit score. Again, your payments are to yourself. There's some sticky rules in there about depending on the plan, but it's not too bad. It doesn't affect your credit score. It doesn't tank your credit if you miss a payment. Okay, so let's go through how much can you borrow from a 401k. Here's the rules. So you can borrow up to 50% of the entire balance, up to $50,000. So for example, if you have $30,000 balance in your 401k, you can take out up to $15,000. If you have $80,000, you can take up to $40,000. If you have $150,000 in your 401k, you can only take, again, up to $50,000 because that is the cap. Okay, so those are the rules. Hope that helps you understand a great source of down payment. Here, I'm Dan, the CPA mortgage guy. Talk to you later.